Hi, this is Steve Gorin. Welcome to my second quarter newsletter webinar. So before we get into the details, I've got some housekeeping. So the program is CLE certified, and CLE certificates will be sent once we verify attendance. If you're seeking CLE for the webinar, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in the verification form that's included in the login instructions sent to you. All CLE questions should go to cle-tc@thompsoncoburn.com. I have 3 different segments, and I do intend to spend a little bit more on the first and last segments than on the second one. You must log in with the same email address you used to register for the webinar, because that's proof of attendance and supports our awarding CLE credit. If you need to leave the webinar, you should log out and then log back in when you return. So again, the webinar is an hour and a half long, and if questions do come in after I'm done, then I'll remain on the line maybe for 5 or 10 minutes to answer questions. The webinar is being recorded and will be available within 10 days at www.thompsoncoburn.com/TCLE. So going on to the next slide. I did my welcome, so let's go on to slide 3. So we're going to talk about a new split dollar life insurance case, Cahill, and we'll also mention, so that's going to be the first segment, and it probably will take more than the half an hour. We're going to talk about a new Roth IRA case that disrespects corporate transactions, and so you know, the Roth IRA investing in businesses is something that not too many people do, so that case is partially relevant for that, but it also has some language that might be a little bit scary for business owners, and I wanted to let people know that that's out there. And then the third bullet point, the third item would be investment partnerships receiving contributions and making distributions, and we talked last webinar about using investment partnerships to try to help shift the management fees to a management company, and instead of paying them a management fee, giving them a profits interest in the partnership. And we mentioned, when we mentioned that, it occurred to me later that maybe you should get some more information on how investment partnerships are run. So that's what the third segment is going to be. So on to the next slide. So Cahill and split dollar life insurance agreements. So first, I'm going to mention how businesses and individuals use split dollar, including what it is, to finance life insurance. And then we'll talk about the income and gift tax effects of using these arrangements, and how the regulations fail to require consistent reporting for estate tax purposes, and how that's led to this litigation that's had some really horrible holdings from a substantive viewpoint. So on to the next slide. So we're on slide 5 now. So we're also going to mention how these rules apply when different generations are involved, and again, how we have these horrible holdings and what kind of planning you might consider going forward. Okay, so slide 6. So that brings us to our first code word, which is split. Since we're talking about split dollars, I might as well have the code word be split. So again, be sure to write this down for your CLE verification. So on to slide 6. So using split dollar arrangements to finance life insurance. So I'm going to step back for a moment and just give you some background on how all this split dollar life insurance stuff developed over time in the law. So the idea originally was, so an employer would buy life insurance on the key employee, and that would be typically a cash value policy. Back when they first started, the only cash value policies were really whole life. But since then, of course, they've evolved where now you've got universal life, variable life, all kinds of different cash value policies. But back then when they started it, they normally would just have whole life. And what they would do is the employer would pay the premiums, and then the employer would agree with the employee that when the employee died, the employer would get reimbursed for the premiums that the employer paid. And then whatever else the death benefit was, that was up to the employee to decide how the employee would want to use it. And so the employee would just name their own beneficiaries. So initially when this came out, so the idea is, okay, so if the employer is putting forth money for the employee, is that maybe some kind of a loan or something? And this was before the Dickman case, which held that if you have an interest-free loan, that actually the interest would be imputed on it. And the context for that really was a gift tax context. So how would this tie back to the split dollar? Because an employer is not really going to be making a gift to an employee. So what would typically happen is that you'd have this cash value policy, and the actual ownership of the policy would be in an irrevocable life insurance trust. So what would happen is the employee creates an irrevocable life insurance trust, and that life insurance trust will own the life insurance policy. And there will be a contract between the employer, the employee, for the benefit of the irrevocable trust. And the contract would say that whenever the death benefit was received, then the life insurance trust would have to make sure that the employer got its share. And the employer would secure this arrangement with what we call a collateral assignment. So a collateral assignment is just like any kind of a pledge of property. So if you had real estate, you'd be doing a mortgage. So the life insurance equivalent of a mortgage is a collateral assignment. And in the collateral assignment form, the insurance company is put on notice that there's actually two people involved in the policy. It's the life insurance trust and the employer. And the collateral assignment generally has vague terms in terms of what the employer gets. The whole goal to the collateral assignment is that when time comes to disperse the life insurance, both the employer and the life insurance trust need to sign off. And that way, the employer is making sure that the employer gets its share of the death benefit, because the life insurance company isn't going to disperse those funds until the employer, signs off that it's agreeing with the way that the money is being dispersed. So that was that's a security arrangement that would go with that. And so what would happen is that when the life insurance trust, basically, even though it held title to the policy, it was agreeing to give these premiums back to the employer. And so so really the life insurance policy kind of had split ownership in terms of from an equitable viewpoint, but from the legal title viewpoint, the life insurance trust owned it. And every year when the employer paid the premium, you'd figure out, well, what is the death benefit part that the life insurance trust is going to get? So the death benefit minus the payment to the employer or the reimbursement for the premiums. So what's that death benefit? So that death benefit was under this construct, that death benefit was the benefit that was being provided to the employee. And so and basically each year the life insurance continued, and so each year the employer would account for it. And so you would account for it by saying, okay, what would be the cost of 1 year of term insurance for that death benefit that the life insurance trust is receiving? And that cost for term insurance, that was deemed to be compensation paid from the employer to the employee. and then a gift made from the employee to the irrevocable life insurance trust. So that's the way it was accounted for on an annual basis. And so it was really accounted for as if the life insurance trust didn't really own the policy, but was just receiving an annual death benefit. And then eventually what happens is the life insurance cost, that annual cost that would be compensation followed by a deemed gift, that cost keeps increasing because as a person gets older, life insurance becomes much more expensive. Somebody who is 50-year-old is a lot less likely to die than somebody who's 90 years old. And so when you're 90 years old, you're going to have a pretty whopping term portion for that. So every single one of these economic benefit split dollar arrangements was really designed that it really has to roll out at some point. You really have to unwind it at some point so that we don't have a deemed annual compensation and deemed annual gift that are really huge. So then when it turns out that the term amount is going to be too high, so then you have what's called a rollout. So you would terminate the policy and repay the employer for their premiums that were paid, and then the life insurance trust will kind of go its merry way, and hopefully by then the life insurance policy has gotten so much cash value that it's relatively self-sustaining, and you don't have to worry about funding the premiums. So when the rollout would occur, let's look at the kind of a dichotomy here. For income tax purposes, this was treated as term insurance owned by the life insurance trust, and for legal purposes, the trust actually had legal ownership of the policy subject to the collateral assignment. So when people would roll it out, so the question would be, how do you account for the rollout? So some people would say, well, the life insurance trust already owns the policy, so the rollout doesn't change the ownership, so therefore a rollout should be a tax nothing. But that wasn't the IRS's position. The IRS is saying, look, you're talking out of both sides of your mouth. You're only treating it as if the life insurance trust owned term before rollout. And then at rollout, all of a sudden you're talking like it's a cash value policy it owns. So you need to be consistent with what you're doing. So in the early 2000s, the IRS issued some notice that it's going to start regulating this stuff. And in 2003, it issued final regulations that basically said if you have a rollout, then any amount of the cash value that's going to the life insurance trust, that is a deemed transfer at that time to the life insurance trust. So that's kind of the big picture on the split dollar regulations, and we're going to go through more of the mechanics on the future slides. But the definition of split dollar under these regulations that came out in 2003 has these three elements to it. So either party pays directly or indirectly all or a portion of the premiums. So for example, if the employee did not want to have compensation income, then maybe what would happen is the employee could pay the employer for the term portion. And then the idea is, well, the employee didn't get a benefit, the employer had to pay for that benefit. But in split dollar, you're still having, either party paying directly or indirectly all or a portion of the premiums. At least one party is entitled to recover all or any portion of the premiums from the life insurance contract. And there's the or is secured by. So just a collateral assignment is what that was referring to. So any kind of arrangement where you have a loan that's called a loan or a loan or an advance of money that's using this economic benefit model, any type of thing where you are basically repaying the premiums by using a life insurance contract. So that's an element. And the other part is it's not part of a group term life insurance plan. So if you have group term, and then everybody really is having term, and so that has its own taxation. It really is purely just term. But if you have a cash value, well, then that's not a group term because a cash value policy is not term by definition. So those are the three elements to be a split dollar arrangement. So slide 7. So the economic benefit regime, that's what I was describing to you before about whether the employer or donor pays all the premiums. But then look at the second bullet point. The employer or donor collects the greater of the premiums or the cash value when the insured dies. So remember, in that rollout, before the regulations, you would just reimburse the premiums. But now with the rollout, it's the greater of the premiums or the cash value. And so if you're going to roll out, actually, the point to roll out that would tend to make the most sense is when the cash value equals the premiums paid. Because anytime you have a cash value life insurance policy, what happens is that the initial amount that you put into that policy, it goes towards certain policy costs that the life insurance company keeps. It goes towards agent commissions, but also there's just some general risk that the life insurance company is assuming here, and there's often what's called a shadow account that the life insurance company maintains. The life insurance company maintains some reserves for the various risks that it assumes under the policies, and those reserves are not part of the cash value, but they are part of what the fair market value of the policy would be. So those of you who are estate planners, you'll find that sometimes when you are transferring a life insurance policy and you're looking to see what the value is, and then we know that generally the way that you would measure the value when you make a gift of a life insurance policy is you get an IRS Form 712 back. And that IRS Form 712 is the value for income tax, for income and gift tax purposes of the policy. And really just mainly the gift tax purposes. So when the Form 712 comes back, a lot of times the Form 712 is a higher value than the cash value. And that's because the various policy features require life insurance company reserves, and from the life insurance company's perspective, the value of the policy is the amount that is reserved for the policy. So a lot of times the Form 712 will come back with a value that's a lot higher than just a cash value. So that's where that all kind of comes from. So the employer is deemed to pay compensation to the employee, or the donor is deemed to make a gift of the one-year term insurance on the difference between the death benefit and the amount the employer is going to be receiving. And so again, the employer will receive the greater of the premiums paid or the cash value immediately before death. And so you would measure what would the employer get if the insured died today, and that amount is reduced from the death benefit to figure out what is the amount that, again, usually the life insurance trust is going to have. And again, that's your compensation to the employee followed by a gift by the donor. But you can do private split dollar too, so you don't have to have an employer involved at all. The donor can simply enter into a split dollar agreement directly with the life insurance trust, and then there's just the deemed annual gift every year. There's no income tax consequences to it. And then the last bullet point on that page, so whenever anybody receives the death benefit under the economic benefit regime, that death benefit is income tax-free as long as you have complied with the normal life insurance rules for having life insurance being tax-free. So in other words, there are some rules about what it takes to have life insurance be income tax-free, and you need to comply with those. And then if you comply with those normal rules, then the split dollar death benefit is income tax-free to both the employer and the life insurance trust. So slide 8. So I mentioned before that the imputed annual term insurance becomes very expensive, and so you need to get the rollout, and you need to have an exit plan for the rollout. So slide 9. So how do you wind up getting the money to the employer? So one way you can do it is simply cash in the policy and give that to the employer. And then that way you're ending with all this, annual high term cost. So in that case, the employer cashes in the policy and is taxed on the excess of the policy's cash value that it receives over the so-called investment in the contract. Now, most tax advisors are kind of used to dealing with the idea of what we call the tax basis. How much you put into whatever you're investing in it. In the life insurance world, there's a different term. Sometimes they're the same number, but they're not always. So life insurance is taxed under Internal Revenue Code Section 72. And Code Section 72 talks about when you surrender the policy, then you have to pay ordinary income tax on the excess of the policy of what you receive, whatever the life insurance company pays you, over the investment in the contract. And the investment in the contract is the premiums paid, and so it will wind up being the basis. And this was not always necessarily clear that the investment in contract would match the basis at this point. In 2009, the IRS issued Revenue Ruling 2009-13, and the IRS said that the term portion of your premiums would not generate basis. And most tax professionals disagreed with that idea because, for example, if you buy a house and you live in the house, we don't reduce the basis in the house by some kind of imputed rent. You buy the house, that's your basis. So with 2017 tax reform, the Congress retroactively repealed Revenue Ruling 2009-13 and said, nope, you're not going to be reducing the basis by these imputed term portions. So it turns out investment contract does wind up being the same in basis, but the methodology used in this first bullet point is whatever the life insurance company pays you minus the premiums paid are going to be the investment in the contract. So that's one way to roll out. Another way might be that the employee pays the employer the cash value. So somehow the employee comes up with the money to pay the cash value to the employer, and then the employer would have gain to the extent that that this payment exceeds the basis. And again, now we know for sure the basis is going to be the same as the investment in the contract in this particular case. And the IRS says, look, if you had cashed in that contract, that would have been ordinary income. So we're going to count that as ordinary income when you sell it. So you want to try to kind of minimize this payment from the employee to the employer. So again, you normally will do the switch when the cash value equals the premiums paid, just to try to kind of minimize any kind of tax consequences. So if the employer is just getting the premiums back at the same time, then that's not going to be any income tax at all to the employer. So another way that the employee can buy out the employer is to have a split dollar loan. So the idea is to convert this split dollar receivable equal to the, which would ordinarily be the greater the premiums paid or cash value, convert that to a loan on which you are charging interest. And I think that's probably one of the most common ways to do the rollout, is you pay the premiums, you wait until the policy has a value equal to the premiums paid, and then you simply convert that to a single loan, and then you use the split dollar loan regime going forward. And with that, let's go to slide 10. So I already mentioned kind of on the economic benefit model about the annual term cost, and one of the issues about this is that you have to make sure that all the cash value is owned by the employer or by the donor, and you also have to make sure that the cash value is accessible by the employer's creditors, and every other kind of thing that has to do with the cash value. I mean, that all the economics belong to the employer. And so one of the issues here, if you had the life insurance trust owning the policy and the employer didn't have total ownership in terms of the economic benefits of it, other than the term portion, if the employer didn't have the total benefit of the cash value, then that life insurance trust would be the deemed owner, and you will have deemed to have transferred everything to the life insurance trust. So the annual premiums themselves would be compensation to the employee, followed by a gift, or if it's just a private split dollar, just simply the annual premiums would be deemed to be gifts. And the whole point about the split dollar is to have a reduced annual amount, have it just be the death benefit portion rather than the amount of the premium. So you do have to be very careful. Now, it could be that the life insurance trust does have the right to manage the policy. It's just that the life insurance trust can't get any of the economic benefit of managing the policy. Another issue, this is the final bullet point on this page, has to do with the employment setting. So if you have this arrangement and you have the rollout down the road, and if the rollout is done, let's suppose the employee simply forgave a split dollar premium and we called it compensation. So then you would have the issue of you have deferred compensation because the premiums were paid, and then later on those amounts actually wind up being given to the employee. So you would have you may have a deferred compensation plan, and there's particular rules under Code Section 409 Cap A, which is non-qualified deferred compensation plans. And if you don't satisfy Code Section 409 Cap A, then the employee is taxed as soon as you have the disqualifying event, which of course could be at the very inception of the contract. But whenever, maybe as you pay the premiums, those are going to be real compensation. So what you might have is, let's suppose you did something after 10 years and you had this compensation that goes to the employee, and oops, you violated the non-qualified deferred comp rules and the way you rolled this out. And so then what you wind up doing is there's some consequences to that. So first of all, when you violate 409A, immediately all the deferred compensation is taxed to the employee. The second thing you do is you go back to the prior years and look to see what the compensation would have been and how much tax that would have generated, and then the employee has to pay interest on that hypothetical tax. And then the third, which is the even worse consequence, is that there's a 20% penalty tax imposed on the employee if you violate it. So in the employment setting, when you do your split dollar arrangement, you need to go and look at Code Section 409A, make sure that you're complying with all those rules of that, as well as complying with the split dollar regulations. Now, generally, I think that if you have where on rollout the employee has to pay the employer the full amount under that obligation, or somehow account for that, so that there's no compensation on the rollout, then I think you're generally going to be okay with 409A. But definitely make sure that you get somebody who knows 409A and does it for a living. Make sure that they've looked at that if it's an employment setting. Okay, so go on to the next slide, slide 11. So in the economic benefit model, again, a rollout would be a deemed transfer from the donor to donee, and also potentially compensation from the employer to employee. And again, if the employee buys a policy from the employer by paying whatever's rolled out, then we're in good shape. Now, grandfathered plans. So any plans that were in effect in 2003 and haven't been changed since then, those plans, so what is the tax consequence on that? So as I mentioned before, before 2003, so some taxpayers would take the position that the life insurance trust already owned the policy, so the rollout really was not a taxable event. And as I mentioned, the IRS is saying, well, no, you're really talking out of both sides of your mouth. So the regulations, the preamble of the regulations put in something that says that the new tax scheme is not supposed to provide any inference for how old plans would be taxed. So if you had a plan that was in place before 2003 and you roll it out later, then you might be able to take the position that the rollout is not a taxable event, even if the life insurance trust is getting the full cash value, and that greatly exceeds the premiums that are being paid back to the employer. So you might be able to take that position. I have generally advised taxpayers that they ought to file Form 8275 with that, because it's in an uncertain position. So I generally recommend that they file that form if they are going to take that position using the no inference language. But I really do tend to prefer, with the rollout, I tend to prefer not relying on that. What I tend to prefer is to go ahead and if we are going to have to, we have the grandfathered and we're having all this cash value, which is now going to the employee. What I would tend to prefer to do, instead of taking that no inference position, is I would tend to say, let's count the whole cash value as compensation, and then we'll do what we call grossing up the employee. So if the employee has to pay tax on that, then have the employer pay those taxes. Have the employer pay a bonus sufficient to pay the tax on the rollout. And that bonus, of course, needs to also be sufficient to pay tax on the bonus. Think about it from the employer's viewpoint. The employer is going to get a deduction for the full value of that rollout amount without the employer having to pay any cash. So the employer gets a deduction, and the employer will be saving income taxes on that compensation income that goes to the employee. So before 2018, the corporate income tax rate was pretty close to the employee's income tax rates if they're in the top bracket. And so you could, the employer could afford, they could take their income tax savings and use the income tax savings from that deemed compensation. They could use that income tax savings to be able to pay for the gross up, to be able to pay the employee's taxes for the employee, because the employer was paying income taxes, was saving income taxes without paying any money, and so the employer could use those income tax savings to pay for the rollout gross up. Now, it's not quite so easy to do that transaction, because if you have a C corporation and their federal income tax rate is 21%, and you have an individual employee who's in the top bracket of 37%, now if you have a 21% tax savings, that's not going to allow you enough cash to be able to tax savings to be able to cover the 37% gross up. So the dynamics have changed with tax reform. The final bullet point on slide 11, if you hold the arrangement till death, then there's no tax on life insurance unless you violate the employer-owned life insurance or the transfer for value rules. And I did do a webinar on this this employer-owned life insurance. If you went to my blog, the Business Succession Solutions blog, then you'll see the webinar. I still have that kind of posted in the history of the things. So that was a couple years ago. I think it was like the fall of 2015 I did that. Okay, so if you hold it till death, there's zero tax to anybody unless you violate these rules. Okay, so let's go to the next slide, slide 12, the loan model. So instead of doing this economic benefit with having the annual term cost imputed, what you do is you pay the premiums, and that's a loan from the employee, from the employer to the employee, or from the donor to the donee. And what's going to happen is every year when you pay the premiums, it would be a separate loan. And so you might wind up with 10 separate loans on this. So that may create a lot of paperwork. This is one reason why what you might want to do is if you take the economic benefit model and you have the annual term cost, and then at the end of the period and you roll it out, you have one loan. So I once heard, I've heard Larry Brody refer to this as switch dollar, because you're taking your split dollar and you're switching it from the economic benefit to the loan model. So each premium payment is a separate loan unless you do a big loan up front and pay the premiums over time. You're not going to want to pay a lump sum premium all at once, because then that becomes what's called a modified endowment contract. And if you're a modified endowment contract, then anytime you take a cash withdrawal from the life insurance policy, it's taxable. Anytime you borrow money from the policy, that's also taxable. So you don't want to do a lump sum. You want the modified endowment contract rules will give you a premium schedule, and I don't know all the rules how they work. They're generally tested over like about a 7-year period of time. But a lot of times I think you can pay your premiums over like about 4 years or so. And so you just need to get your life insurance agent to model out modified endowment contract, MEC or MEC. So what you need to do is just say what premium schedule, what's the biggest premiums I can pay without violating the MEC rules. The life insurance agent will get you that from the life insurance company, and so you can use that for your schedule. So now the life insurance loan, it's not going to get repaid by the employee right away or by the life insurance trust right away, because typically it doesn't have any cash. So normally you're just reinvesting the interest every year, but that interest will be recognized under the original issue discount rules, even though it's not paid. So there will be an annual income tax cost for the interest that the employer or the donor is going to have to pick up. And actually, if you have an employer concept, what you're doing is the employer would have imputed interest, but then maybe you'd have some kind of a compensation element going to the employee. All right, let's go on to the next slide, slide 13. In the loan model, contingent payments are disregarded. And because split dollar loans are generally non-recourse, they may be contingent. So to guarantee recognition of the loans, there's an election you ought to make on the tax return when you get the split dollar arrangement in place. So next slide. So again, slide 14, that was the switch dollar I was talking about. And the main risk you're taking is interest rates might change between the time you had your first premium paid and the time you do the rollout. So if the interest rates increase, then there's going to be a higher interest rate loan, which might not be as good. So next slide. So the regulations for the split dollar do not tie estate tax treatment to income or to gift tax treatment, and so there's an inconsistency potentially. You use the usual valuation principles to determine the split dollar obligation payee's risk. And so if there's lack of control, lack of marketability, other factors, there could be discounting available. So go to slide 16. Normally, if you just have the donor is the insured and they're going to get repaid when they die, there's no discounting that goes on. But think about an older generation. And if you have a policy that's going to be in place for 20, 30, 40 years after the donor dies, and they have no control over how that money gets invested, and they have no say-so in like what happens if the policy isn't performing well, they can't call the loan early the way a lender could. So the bottom line is that the split dollar receivable will get a big discount. Slide 17. And so again, they're tied up for many years, much longer than the commercial loan. So go on to slide 18. So with the split dollar loan regime, again, any payment from the life insurance to repay the note would be treated as a payment from the insurer to the borrower and then from the borrower to the lender. So if there's any accrued interest, the payment would be ordinary income if not yet taxed. But given that the OID rules will tax these annually, there probably wouldn't be an annual interest. Now, if you have an irrevocable grantor trust, then that interest is not being recognized because it's disregarded. So when the owner dies, you have accrued interest. Is that considered to be accrued interest, or does that consider to be principal because there's really just a transfer what occurs at the grantor's death for income tax purposes, and so maybe the loan didn't really exist for income tax purposes until the grantor died, and so maybe the accrued interest is really considered to be capitalized as principal. I don't know the answer to that question. Go on to slide 19. So if you have a low basis because it gets discounted, consider the character of the note repayment. So let's suppose that you had $1 million loan and it was worth only $150,000, which is not out of the question from some of the valuations. So what happens when you have the $1 million principal payment and you only have a basis of $150,000 because that's what was the basis of death? In that case, then the question is that capital gain or not? So it might be capital gain or it might be ordinary income, and it's uncertain what the treatment is going to be, and my materials go over that. Slide 20. And that's your dichotomy there. If the decedent's estate is considered to be the issuer, then it should be capital gain. But if the estate is not considered to be the issuer because the decedent actually was the issuer, then the gain will be taxed as ordinary income. So I don't know the answer to that, but that's just out there for you to think about. So slide 21. And the economic benefit regime if all parties hold the policy in place until the insured dies, there's no tax on the death benefit unless you blow the other life insurance rules. So if you go back again and you have a split dollar receivable, an economic benefit regime, and it has a $1 million cash value and $150,000 was the value on date of death, and then the $1 million winds up getting paid back to whoever owns that split dollar receivable. If that's paid via death, then there is no income tax because it's life insurance. So the fact that you got your basis basis step down, the fact that your basis got reduced down to the 15 cents on the dollar, you don't have to pay income taxes on that difference if you hold the economic benefit until death. Now on rollout, if you roll it out, then again, you're not going to get the basis step down. What happens is the investment in the contract, if the rollout, on the rollout, if you are getting it cashed in, if the policy is cashed in on rollout, then you get to use the investment in the contract, and rather than the basis. So the fact that the basis is lower than the investment in the contract, that does not affect the taxation if you have it cashed out, if the contract gets cashed in. But if the deemed owner sells the policy, so whoever has the split dollar received sells the policy, then you do use the lower basis. And you can see that there's ordinary income to the extent of cash value and capital gain beyond that. So slide 22, we mentioned these cases, Morissette and Cahill, they had huge discounts and no gift tax on the creation of the split dollar agreement. Slide 23. The taxpayer moved for summary judgment in Cahill, saying that the rights to terminate and recover the cash value were rights that would trigger 2036 or 2038. Going to slide 24. Also, 2703 would be triggered. Go into slide 25. And again, the court denied the estate's motion for summary judgment that 2703 didn't apply. So go on to slide 26. So I do have separate materials, including the webinar meeting materials. So Steve Akers' analysis, which was sent, Steve Akers' analysis, which is on the web page, and the Levine post-trial briefs that were sent. Levine is another split dollar case that didn't have the motion for summary judgment. Instead, they went to trial, and the post-trial briefs were included in your email, and you can look at those. So slide 27, whether Cahill is right or wrong from a technical legal argument, that's something you can look at Steve Akers' materials. He does a wonderful job of dissecting the issues. Whether the court is right or wrong, it looks to me the tax court is applying a smell test, and so you really want to see whether this is doing just to be discounted. Slide 28. So Morissette involved life insurance to fund a buy-sell agreement between siblings, so that seemed to have a good business purpose. However, those siblings owned a business. They owned that business, and what they did is the donor was incapacitated, and so the donor's children arranged to have their employee appointed as conservator, and the employee facilitated the split dollar and also facilitated the donor's revocable trust, bequeathing the split dollar receivable to the life insurance trust. So the receivable, basically Morissette said the receivable is being included in the estate at 25 cents on the dollar, but that receivable is going to go away immediately after death because it's being bequeathed, and so they're kind of trying to have their cake and eat it too with that. So slide 29. So I think that really what you want to do when you're going to look for premium financing is consider the possible financing methods. And if significant discounts are involved, then be prepared to document for the IRS why split dollar makes the most business sense. and also consider how the income tax exit strategy would work. And so build up your case, because the IRS will challenge it, and you'll wind up in tax court, and now you're going to have this tax court applying a smell test. And again, whether the tax court gets reversed or not, that's who you're going before. And so you're going to want to build your case to make sure that you've proven why split IRA makes the most sense. And you also always need to consider the income tax exit strategy. So one of the things that we kind of thought of, well, actually, I think that might be the next slide. I'm going to wait till that. But also, in terms of valuing these split dollar notes, the IRS did have a project out to issue regulations on notes. Those regulations might very well have been issued in 2018, maybe even earlier, but for the fact that we have tax reform. And so the IRS is devoting significant resources to tax reform. And so that they really haven't had time to finish up getting the proposed regs out and valuing notes. So the note receivable, we still have the discount opportunities until those regulations come out. Next slide. Okay, so actually, before I get to the next topic, one suggestion that I had thought of, or a lot of people have talked about, is the split dollar loan regime looks to be less susceptible to some of the risks, some of the income tax risks by failing to meet all the rules than the economic benefit. The economic benefit, you have a slip up, and you might wind up having all this huge tax effect right away. The split dollar loans, as long as you have your arrangement in place and you do your election on your return, then you're not going to really have a slip up. But in the prior slide, I mentioned that the economic benefit can wind up, if it's going to wind up being discounted, the economic benefit is more likely to have favorable income tax results. So the economic benefit regime is what these cases have been tried under, and even though there may be some reasons why the economic benefit regime might be more risky, it does seem, if you're actually going to hold this policy for a long, long time and not collapse it after death, that would make more sense. The other thing that's in my materials is that if you had a split dollar loan and you bequeathed it like they did in the Morrissey case, if it were the loan regime, then doing a bequest of the loan right after you enter into the loan, there's a very good chance that the IRS would be able to come in and say that you can't use the split dollar rules. That's a deemed transfer of the entire amount. And so look at my materials for that. So the next code word is Roth. So go on to slide 30. There's an ongoing saga of taxpayers investing in the Roth IRAs in private businesses. And I'm going to talk briefly about the Mazzei case and tell you about this language that you won't like. Slide 31. If you have a Roth IRA owning a business, the IRS wants you to disclose that as a listed transaction on special disclosure form. My materials go into more details on that. The IRS has litigated these things for a while, and they tend to lose. So slide 31 refers to a case. This was actually what's called the Bross trucking case, when that was a transfer of a business, a deemed transfer of a business, and the IRS wind up losing that. Slide 32. If an IRA invests in a business, you have a lot of susceptibility to prohibited transactions that can cause penalties and cause the IRA to be busted. It's a deemed distribution for the entire IRA at that time, and the IRA winds up just being like a taxable trust from that point on. And so here's the issue. If the owner provides services to the business that the IRA owns, so you have the IRA owns a C corporation, and the person who owns the IRA provides services to that C corp. So if the C corp pays the owner compensation, then that's a prohibited transaction because the IRA is the ultimate owner, and the IRA has indirectly paid compensation to its owner. That's a prohibited transaction. If you don't pay compensation to the owner for working in the business, then the owner has contributed those services, and the IRS would take the position that that's a deemed contribution to the IRA, and so that causes problems too. So you need to have your business be one in which the IRA owner is not working. Slide 33, and also none of his family members or friends are working in there either. Now, started businesses typically have loans from banks, and normally owners have to guarantee the bank loan, but if the IRA's owner guarantees the bank loan, then that's going to disqualify the IRA. So generally, you're not going to want to have a business inside of an IRA. In slide 35, this kind of talks about the history of a couple of cases. One's called Summa Holdings, and I'm going to talk about that in a moment. The IRS won at the tax court level and then lost on the Court of Appeals. Slide 36. So these cases involve what's called a DISC, or a foreign sales corporation, and the idea of these are shell corporations that receive commissions on exports. And this was a contrivance that Congress specifically authorized to provide tax subsidy exports. So the idea is that the exporter pays a commission to the special corporation called a DISC or an FSC, and the exporter gets a deduction for that, so that saves taxes. Then when the DISC or FSC receives those commissions are tax-free because of the special tax rules. And this can be a shell corporation. Congress said it can be a shell corporation, so it's perfectly fine from an income tax viewpoint. A Roth IRA, think about the Roth IRA capitalizing the shell corporation, so you don't have to put any, you put nominal money into it, so then all of a sudden you get all these commissions that come into it. So poof, a nominal contribution to the Roth IRA turns into a nominal contribution of a corporation, and then all these commissions come into it, so you have lots of money flowing into the Roth IRA, to the corporation that's owned by the Roth IRA. So let's go on to slide 37. So in Mazzei, there was a foreign sales corporation, and they basically said that we are going to disregard this corporation, and here's how they did it. Slide 38. So what they said is that the dividends from the foreign sales corporation, were to the IRA, were really considered to be dividends from the foreign sales corporation to the IRA owners, followed by them putting that money into the IRAs. And you can, but look at the opening sentence there on that bullet point. Because petitioners controlled every aspect of the transfers in question, we conclude that they were the owners of the stock and not their Roth IRAs. So that's kind of scary language. If you work too much, we are going to disregard the ownership structure you put in place. Next slide. So then those deemed dividends to the IRA owners, followed by the contributions of the IRA, Roth IRAs, were therefore excess contributions. Furthermore, the court viewed these commission payments as voluntary because the exporter didn't have to use that foreign sales corporation to run its transactions through. It could have set up another one of them. So the court said, look, there was no contract between the foreign sales corporation and the exporter, so these were really voluntary payments, and that's really another reason why we view these things as being dividends, being dividends out to the IRA owners, followed by the excess contributions. Next slide. So then here's another thing. Look at this slide 40. The court said the Roth IRA's formal purchase of the FSC stock for $1 did not reflect the underlying reality. That the petition, that the taxpayers, they were basically directing these large commission payments into this corporation. So this corporation was going to have a ton of value from these commission payments, and yet they only put $1 in for it, so they didn't really pay fair market value for the stock. The Roth IRA didn't pay fair market value for the stock, therefore the Roth IRA shouldn't be considered to be the issuer. I'm sorry, the shareholder. The corporation wasn't deemed to have given the stock to the Roth. It was deemed really issued to the IRA owners. Slide 41. So they said they and not the Roth IRAs were the owners for federal tax purposes. Slide 42. But the dissent, this was a reviewed opinion, the dissent countered, but the founding shareholder doesn't have to say, oh, I hope this is going to be really successful, and so therefore I have to invest more into my corporation. So the dissent said, no, that's not right. You can put $1 into the corporation and have that be adequate capitalization. And I think the dissent has a very good point there. In fact, I agree with the dissent that if you don't know what your profits are going to be, I mean, any start a business, if it doesn't require capital, you don't need to put much money in. You just need to put enough money in to be financially responsible for your debts and your obligations. And if this corporation didn't have any debts or obligations, then you don't really need to capitalize it with a whole lot. So the dissent said, you know, you're disregarding them because they didn't put enough money into the corporation. Well, if you do that, you know, then you're going to set some kind of arbitrary rules as to how much money you have to put in order to consider your corporation for tax purposes. That's nuts, the dissent says. So the next slide. And there it is, that nuts argument. So you can read that some more later. So slide 44. The majority said, no, that's not right. If you have a speculative company, then your value and what you put in are the same, and in normal businesses, the value would just change as it goes up, and so it's different because we knew this was going to be successful, and so since we knew it was going to be successful, you had to capitalize it with more money. So slide 45, I think the majority is contradicting itself. On the one hand, it says that the corporation that was owned by the Roth IRA was worth a lot more than the original contribution. On the other hand, it says the taxpayers controlled the contracts with the foreign sales corporation. So, you know, the exporter didn't really have to do business with the foreign sales corporation. So it really was a voluntary payment. Well, if it was a voluntary payment that the corporation was receiving, then how could you say that it was expected to make lots of profits? Because that was a voluntary payment. So I think the majority is kind of contradicting itself here. I really don't see any distinction between this and the Summa Holdings case that got reversed by the Sixth Circuit, and I think it was the First Circuit as well. But to me, what this really shows is that the tax court is applying its smell test. It doesn't like this because the Roth IRAs got lots of a really valuable company in them, and it just didn't like the way that got done, and so it's applying a smell test, and it's going to just throw the book at the taxpayer. So slide 46. So I'm done with that segment. I haven't seen any questions yet. I'm going to go on, and the code word here is investment, because now we're going to talk about investment partnerships. So slide 46, I'm going to talk about some potentially unexpected tax results that people who are not experts in partnership tax might not always be aware of. I'm going to talk about rules for accounting for partnership investments, and actually how you might want to follow the ideas there, but not do all of the steps that they suggest. And also talk about the idea that investment partnerships, you really shouldn't be using it like a mutual fund where you can put money in, take money out, put money in, take it out. You really shouldn't be doing that. You should be investing and holding, and then you don't take it out until way, 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 way down the road. So let's go on to slide 47. So generally, partnership formation is tax-free. So you form a partnership, you know, I put in my asset and you put in your asset and we form our partnership, and so generally that's not going to be a taxable transaction. And distributions are also tax-free. Now the formation of the partnership, I'm not going to spend time going on the formation, but the bottom line is that if you are contributing some kind of securities into the partnership, and like if I put in Apple stock, and then you put in some Coca-Cola stock, and that's all we put in, we've diversified our investments, because now that I put in my half and you put in your half, now I own half of Apple stock and half of Coca-Cola stock, and you own half of Apple stock and half of Coca-Cola stock. You've diversified your investments, because you know you start off with owning only the Coca-Cola stock, and then you wind up with having half Coca-Cola stock and half Apple stock. So there are some investment partnership rules, some rules on the formation of a partnership, so you need to watch out for those. I'm not focusing on those here, but my materials do go over them and they do refer specifically to them. But when you make distributions, again, generally that's tax-free, but there are some exceptions. So, and by the way, so when I say generally, so I know I do have some people from the South here, so I'm not talking about the great Civil War general, you know, Robert E. Lee. So I'm not talking about General Lee. I'm talking about the word generally. So anyway, there are some exceptions to the idea that distributions are tax-free. So one of those exceptions is if you distribute marketable securities, then those distributions might be considered to be as if they were distributions of cash. And if you don't have enough basis in your partnership interest, then those deemed distributions of cash can generate income tax. Now there are some exceptions to that, and one of those is if you're what's called an investment partnership under those rules. So our investment partnerships may very well comply with those rules. But I just wanted to let you know when you start off with the investment partnership, you need to have an eye toward the rules I have here in this first bullet point. Not only do you need to make sure you're not diversifying, as I mentioned when I first started talking about this slide, but you also have to look at whether this is going to be a qualified investment partnership. There's actually a definition of investment partnership in Code Section 736C. So the other part here at the bottom of the slide is these Code Sections 704C1B and 737. So distributions of property where the partner had contributed property with a basis that didn't equal value. And so I'm going to go into this a little bit more. So let's go into slide 48. Slide 48, there's more exceptions. There's the so-called disguised sale rules, and I'm going to go over those a little bit later. So let's go on to slide 49. So when you contribute property with a built-in gain on that, that built-in gain is called Code Section 704C. So if I put in stock with a basis of 10 and the value of 50, then that $40 appreciation in there, that's built-in gain. That's called Code Section 704C responsibility. if I put in the stock worth $50 into the partnership, and then I'm a partner with you, a 50-50 partner with you, and then that stock later sells for $100 a share, okay? So then we've got $40 gain came in from before I had it, before it was in the partnership, because I had the $40 built-in gain. So $40 of that gain is from my built-in gain, and the other $50 is post-contribution. So the $50 post-contribution gain, that's going to be split between you and me equally because all that gain occurred while we were partners. But the $40 gain that was built into it, that was my gain that I brought into the deal. So what happens is when this property gets sold for a $90 gain, I'm going to get taxed on the $40 built-in gain on all of that. And then I'm going to get taxed on half of the $50 gain. So half of the $50 gain is $25. So $25 from my half of the gain from the post-appreciation, and then $40 from before, so I'm going to get taxed on $65 of gain. So even though I'm getting only a benefit from, like I'm only getting a $50 sale proceeds are getting allocated to my capital account, I'm going to have to pay tax on $65 because I already got credit for this gain when I put the $50 worth of stock in. My capital account got credit with $50, and so I already have gain for that. So I already have credit for that. So I have my $50 original capital account, and then I have my $25 share of post-contribution appreciation. So my capital account is $75, $50 from my initial contribution, $25 from my half of the post-contribution gain. So I have a $75 capital account. I get taxed on $65, and now everything is kind of evened out. I had a $10 basis. I got taxed on $65. Now I have $75 I was taxed on. My capital account is $75. So now everything has been evened out. So when that property gets sold, I get tagged with gain or loss on the sale. Now, if that asset leaves the partnership and goes to somebody else within 7 years, so then I'm going to get hit with a tax. So I put in my Apple stock with my $40 built-in gain. The partnership later distributes that Apple stock to you worth $50. It distributes that to you. So now this original deal that, that when the asset is sold, if the partnership sells the asset, that gain gets allocated to me, that $40 built-in gain gets taxed to me. Well, if the property is outside the partnership, then that rule can't apply. So if the property is leaving the partnership, we need to have a check on that if that asset gets distributed within 7 years, if it gets distributed to you, then when that goes out to you, I'm going to get hit on my $40 built-in gain from when I contributed it, because there's no other way to tag me with that $40 gain once it leaves the partnership. So that gain gets allocated to me, and that was what 704C1B was talking about. Then the other issue is, what if I contributed that Apple stock, and then within 7 years, I take out the Coca-Cola stock you had contributed. So if I take that Coca-Cola stock out, so I've gotten something different than the Apple stock that I put in. And so when I get out this other property, then again, if I'm out of the partnership, so then I'm not going to get taxed on my built-in gain when the partnership sells it. I need to get taxed now on it. So if the asset's distributed within 7 years of the contribution, or if the contributing partner leaves and gets something else within 7 years, then there's going to be taxation on that built-in gain. Okay, the next slide. I did have an email question. how do you maintain tax basis capital accounts in a deal like this? So let me go back and explain what the partnership tax rules say, and also some accounting that people tend to use. The partnership tax regulations under Code Section 704(b), so 704(b), they say that whenever you contribute property to a partnership, each partner has to have given a capital account equal to the fair market value of whatever he or she contributed. So when I contribute my stock that's worth 50 and has a basis of 10, I get a capital account of $50. That's what the regulations say is required to be done. Now, people also like to track their tax basis. So it's very common for income tax return preparers to say, I want to keep track of the $10 basis, because when I put in the $10 of $10 basis Apple stock, I want to track that my partnership interest in the Apple stock has only a basis of $10 because that's what I put in, and there was no gain on record when I put it in, and so that $10 basis stays with me. So that $10 is a tax basis. So what CPAs will commonly do when they prepare tax returns is they will report a tax basis capital accounts. They will show on the tax returns, they will show that my capital account is $10, not $50. And the instructions of the tax returns let them do that. Even though they do that, the regulations require them to keep fair market value on contribution accounts, the 704(b) accounts. So in that case, they need to be keeping two sets of accounts, the $10 tax basis account and the $50 fair market value account under 704(b). They're required to do that, and they're supposed to include they're supposed to do a reconciliation between the two accounts. And a lot of them don't do that. Now, so that's how you maintain the tax basis capital accounts. So be aware of that. Now, we're still on slide 50, and we're going to stay on this for a little bit. So let's suppose that that you and I are partners in this partnership, and we might even have put in, maybe I put in $50 and you put in $50, so we have $100 into our partnership. Okay, and so we put in cash. We don't have any 704(c) responsibility because there's no built-in gain. Now, let's suppose that we have a partner, and for the sake of convenience, I'm just going to call that partner Mike. So Mike puts in. So what happens is, so first of all, we have the $100 we put in, and now the partnership has grown in value. Now the partnership is worth $200. So we have assets with a fair market value of $200 and a basis of $100. Okay. Now, Mike comes in and he's going to become a 1/3 partner. He's going to contribute. Mike is going to contribute $100 of cash to our partnership. So we have $200 worth of value of property. He puts in $100 of cash. Now it's $300. So now you and I, we were 50% partners. We get diluted. Everybody's a third, a third, a third. Okay, because my value of my partnership interest was 100 when he put his property in. Yours was 100 when he put his property in, and then his is 100. So we're splitting that a third, a third, a third. Okay, but Mike put in $100 of cash, so he has no 704(c) gain built in because he put in just cash. Now we don't have any 704(c) gain because we put in cash too. But when Mike put in his $100, we got credit for the fact that our asset had grown up to be worth $200. And our asset has $100 of appreciation in it. So we're getting credit. When Mike comes in, our capital accounts get booked up to $100 each. Instead of being $50 each as they started with, they're now $100 each. They get booked up to $100. And that $50 book up from my $50 original contribution to my current $50 gap value, that has a built-in gain. Now, it's not built-in gain from our contribution, so it's not 704C gain. What it is instead is what we call reverse 704C responsibility. So you and I have this appreciation from which we're benefiting because we got credit for it when Mike put in his $100. We got credit for it, for that appreciation. And so we have a built-in gain of this reverse 704C responsibility. And the partnership needs to track both the 704C built-in gain from when we put property in, if we did, and also the 704C, the reverse 704C, when we benefit from the appreciation when somebody else puts property in. So if you have a marketable securities portfolio, that can get cumbersome. It can become a pain in the behind. So what do? So the partnership needs to track both of these elements, the 704C and the reverse 704C. But the more complex thing is people putting property in, and you have all these built-in gains things inside. Like you might start with the cash. If everybody put in cash, maybe nobody has any 704C responsibility. But as you have people putting in more cash, and you have more value inside the partnership that's grown through the internal reinvestments, you might just have a bunch of this reverse 704C responsibility. Now, 704C responsibility is always going to be on a property by property basis. Okay, but the reverse 704C, you might be able to aggregate that. Look on the next slide, slide 53. A securities partnership may aggregate gains and losses from qualified financial assets using any reasonable approach that's consistent with 704C's ideas. That's what the regulations say. Now, the aggregate approach is only for the reverse 704C. So it does not apply to the built-in gain for the contributed property. You still have to separately account for the built-in gain on the contributed property. So it's only for the partnership's reinvestment. So I'll go on to slide 54, or the post-contribution appreciation. So contributed assets with a built-in gain or loss will complicate accounting on a permanent basis, but accounting for unrealized gains or losses can be done on a streamlined basis. Also, the built-in gain responsibility follows the partnership interest. So you might have one person fund an LLC, and then they might give their LLC interest to their kids, for example. And when they give them to their kids, so their built-in gain responsibility shifts. So if I had that stock with a value of 50 at a basis of 10, so I have $40 of built-in gain. If I gave half of my partnership interest to my kids, then I would have built-in gain responsibility for 20, and they would have built-in gain responsibility for 20, because they've gotten half of my partnership interest, so they get half of my built-in gain. Okay, slide 55. So when are you a securities partnership? You either need to be registered with the SEC or be an investment partnership, and under the SEC, not the tax rules, but the SEC. And the partnership has to make the book allocations proportionate to the book account. So go on to slide 56. So are you an investment partnership? Yes, if you hold qualified financial assets for at least 90% of the fair market value, and you are going to take an aggregate approach. Slide 57. You can use a partial netting approach, which allows you to just net the book gains and book losses since the last time you did a restatement of the accounts. So like every year you might just, whenever you do the restatement, you can just net the gains and losses. You don't have to go back and redo all the layers again. Go on to slide 58. So there's a partial netting and a full netting, and so you can go and look into those details I don't have time to go over it right now, so let's go to slide 59. But the character and tax attributes of the gain or loss has to preserve the tax attributes, be consistently applied, and you can't be playing any tax games with it. Slide 60. Now, if a securities partnership adopts an aggregate approach under these rules and later fails to qualify, then it has to make the reverse allocations on an asset-by-asset basis. But it's not required to disaggregate those book gain or loss for anything that occurred before the date of disqualification. So it's only after. Go on to slide 61. So the big issue is if you formally make an election to make those rules and something occurs to make you not qualify for them anymore, then that causes a big accounting mess. And so you have to go back and look at slides 59 and 60 to see all the consequences. But if you don't formally adopt it on your return and simply put it in your books and records and use the same methodology, that is what people tend to do. People tend not to make that election, but to just do the but just do the aggregate approach and practice for marketable securities. And then if you have unmarketable assets, then you would do an asset-by-asset approach for those because you're not going to go and revalue those every year. So the idea is use those principles. So slide 62. So given that the regulations allow you to use any reasonable approach, and given that the IRS has given us approaches that it thinks are reasonable, it would seem to me that if you use this hybrid approach I mentioned with the marketable securities, follow the methodology, and unmarketables don't, I think that if you just use that in your books and records without making the tax election, that is going to provide you with the most flexibility. Slide 63. So as a practical matter, I don't see the IRS going and auditing these things. Now, I don't know. I can't promise you anything one way or another, but whether the IRS would audit or not. But I don't really see the IRS examiner say, well, you use this method that we suggest in our regulations. I think you should use a different method. You know, how's the IRS going to say that their method is any different, better than yours when your method is already following the regulations that the IRS has already improved? So slide 64. Finally, investment partnerships. I'm concerned with disguised sales. If you have non-cash assets that move within 2 years of cash being moved, then there can be a deemed disguised sale. Excuse me. So there's two ways to look at this. So if I put in securities and I get cash out within 2 years, that looks like a disguised sale from me to the partnership, but there are exceptions that you can take advantage of. So these exceptions are like, if the partnership doesn't distribute to me more than its operating cash flow, then I don't have a disguised sale. If it gives me a reasonable return based on my investment, then I don't have a disguised sale, because the IRS is really concerned about you receiving more than just a reasonable return. They're concerned about you receiving cash back, basically converting your capital account to cash. So, but if you think about the opposite way, suppose the partner contributes cash and the partnership makes a non-cash distribution within 2 years. So the partnership isn't going to be looking to my cash flow. I'm not accounting for my cash flow and stuff like that. So those exceptions that apply when you contribute cash and receive property, when you contribute property and receive cash back, those exceptions really wouldn't seem to apply when you contribute cash and the partnership distributes property to you. So those make it look like a deemed sale from the partnership to you. The partnership has gotten cash, you've gotten those securities. So those don't seem to have the exceptions. So be really careful about, if you put money in and receive a non-cash distribution, we need to try to prove that that's not a disguised sale. So go to slide 65. That's the conclusion. So I know that I sped through these last two things, and I hope that I haven't lived up to the motto of a tax advisor being somebody who solves a tax problem you didn't know you had in a way you don't understand. Hope you've been able to follow these. You're welcome to ask me more questions. I encourage people, if you're doing fiduciary income taxes, you can go and look at my fiduciary income tax refresher and update. My next webinar is going to be October 30th for my third quarter newsletter. The Code Section 199 capital A regulations should be out by then, and so I should have a good analysis of those for you in my newsletter and then again on my oral presentation. You can also, of course, check out my blog and my other materials there. So thank you for listening. Hope to hear from you. Have a good day.